I am Diego Cerdeiro. I am a PhD student at the Faculty of Economics. And we're here with Stephen Morris, who is visiting the faculty hosted by the INET Institute. Stephen is the Alexander Stewart 1886 Professor of Economics at Princeton University. He's a fellow of the Econometric Society and of the American Academy of Arts and Sciences. And we're very glad that you were happy to have this brief interview so that we can ask you about your main research areas and their applications. So the first question that I wanted to ask you is that lately there has been a lot of interest in robust mechanism design, and you have yourself contributed actively to this interesting area. So could you please tell us what questions does robust mechanism design seek to address, and in which situations is it of particular importance?
I think that, by way of background, mechanism design has been this hugely successful development in the last 25 years in economic theory, giving a sort of overarching framework to understand how you can design a game, which could be an auction or an institution more generally, in order to achieve particular objectives. So we have this whole elaborate and beautiful theoretical framework that is a way of understanding how you design those things. I think that there's been this dichotomy which has frustrated people, that the theory is very nice, but what it suggests as mechanisms can sometimes be a little bit complicated. So it's a pretty theory, but it's not clear that all the answers are applicable. Now, on the other hand, mechanism design has been very influential in practice, but the practitioners don't take the full theory. They tend to use simpler mechanisms because they think that the optimal mechanisms are too complicated. So this is where robust mechanism design comes in. It says, can we model the richness of the environment that explains why the first generation theory fails to be convincing for practitioners? They don't really believe you could do that in practice. So can we better represent the constraints that are out there, often informational constraints? The designer doesn't know as much as you might think he does. How can you use that to understand mechanism design? So the work that I've done, which you might think of as a sort of first generational foundational work, is more about just saying, how do you model the richness of the informational environment in a way that explains why the unrealistic, complicated mechanisms wouldn't work, and why you need to have mechanisms with more robust properties. So endogenously explaining what makes them robust, taking into account the fact that there's less common knowledge, less informational agreement than the standard models assume. Mm-hmm. So, in terms of where it's been applied, the first generation of auction theory has been hugely influential in lots of areas. Now it influences how spectrum gets sold in multi-billion-dollar auctions across countries, how school places get allocated. These ideas are becoming very endemic. I think that what the robust mechanism design has done so far is more just explaining why the mechanisms that people think work well are the best solutions to the problem, and the next generation would be kind of coming up with new insights into how you do it.
Thanks. So the second question is on another topical issue, and at the core of the financial crisis there was this run on the shadow banking system comprised of the less regulated elements of the financial system. And the question is, in what ways do you think that the global games literature, of which you were a main contributor, can shed light on understanding and managing these events?
Okay, so that's an issue that I've thought a lot about. The joke that I always tell is that that after the financial crisis, everybody was working on lots of different topics, and whatever topic you were working on, when the financial crisis came along, everybody concluded that what they were working on was the best thing to explain it. So I'm certainly in that category, that for exactly the reasons that you give, the coordination problem and shadow banking, that sort of global game analysis makes sense to understand it. And actually, I kind of think that neither I nor other people have done as much as could have been done. Of course, people have done zillions of things on the crisis, and somehow less than might have been done has been done with the global games logic. I mean, a couple of things that I did, somewhat motivated by the crisis, both with Hyun Shin, is one was looking at, we have a paper called Contagious Adverse Selection, which was trying to, focusing on a particular source of coordination in financial markets, which is the existence of adverse selection. So if there are bad assets out there, then there's a coordination problem among uninformed traders, whether they enter the market or not. Uninformed traders only want to trade if they think there'll be lots of other uninformed traders out there. So that creates a coordination problem. So you know, we developed a model in order to make a link between adverse selection, which people can see playing a role in the crisis, and how that generates a coordination problem. So that's one direction of research. You know, another paper that I guess we worked on since the crisis is, you know, the crisis brought back in all different contexts, so both the European sovereign debt crisis and, you know, banking issues in the US brought back this old classic question of solvency versus illiquidity. So is this country or this bank, is it facing a solvency crisis, or is it meaning that, you know, they don't in the long run have the resources to pay off their debts? Or is it an illiquidity problem? If you just leave them in peace, they will be able to repay it. But so, you know, that's a classic debate. And I think the global game's perspective is kind of that this distinction is not as sharp as you might think it is. So, you know, the global game's perspective is saying, let's look at the coordination problem among lenders, whether it be people who are buying sovereign debt or people who are investing in banks through the shadow banking system. The line between a solvency crisis and an illiquidity crisis in our understanding of the world is not so sharp. It interacts with what's going on in the information structure. But what using global game modeling can do is it can allow you to quantify you know, what are the returns to injecting more liquidity in the system, so more reserves in a banking system. It gives you a way of thinking about those issues. So it's both giving you a theoretical framework to make sense of the liquidity versus solvency issue, and designing policies that recognize that there are elements of both in lots of situations, and what's the best thing to do.
So the third question that I had is actually related to some of the things that you have been already explaining. And so to frame the question, so recently European policymakers have been worried a lot about contagion via financial markets from one country to another, but there doesn't seem to be a consensus on the relative importance of different channels through which the crisis could transmit from one country to another. So it could be cross-country liabilities, it could be through fire sales. And so the question is, what do you think are the most important channels of contagion? And what tools could be used to ring-fence local crisis from spilling over to other markets?
Mm-hmm. Okay, so in terms of what are the channels of contagion, let me address that first. I mean, I have to say I'm a bit of a theorist, so my comparative advantage is more in understanding how they translate rather than what's the most important one. Now, I do talk to a lot of people about it, and you know, the fire sales, some version of fire sales seems pretty important. So basically, by you know, fire sales broadly interpreted is just the fact that if people are trading in the same markets, then when some people start selling, then others may be forced to sell, so that there's lots of people selling at the same time, and this creates and this is the ultimate source of the coordination problem. I think that that has played an important role in the European crisis. And people talk a lot about the cross-holdings, but you know, you do calculations, and you know, many times when the immediate cross-holdings are controllable, it's more the fire sale externalities that might make a difference. Now, in terms of doing policy, this is something that I have thought about a bit, although I haven't finished work on this. But I think that it's a really important question for modeling, and where economic theory could really help. So, you know, the question that you raised is, How do you design policy so as to stop contagion? So we can think of it as like creating firewalls, where we say, okay, and at the beginning of the crisis, everybody was saying, well, if Greece goes down, then everybody goes down. So we've really got to save Greece. But then after a little bit, things kind of changed, and people, Italy had been shored up a little bit, things had stabilized a little bit elsewhere. And then people started to say, well, maybe Greece can go down, maybe Greece can default a bit, which they have, and maybe we can save the rest of the system. So people talk about these issues, but don't have a very good theoretical framework for thinking about it. So I think an interesting question, so a place where theory could play an important role, so something that I've thought about doing but haven't done, is to say, suppose you have so much money to spend, so the European Union and the ECB has put together a certain amount of money for interventions in sovereign debt markets. What's the best way to spend it? Should you give up on Greece and draw the line at Italy, or should you spread your resources across countries? If you're going to explicitly or implicitly guarantee debt, should you guarantee 100% a small amount of debt, or only 10% of a bigger set of debt? These are questions that people are talking about. I think that a global game framework that you mentioned earlier, so modeling the incomplete information as a source of strategic uncertainty that people face when people are deciding whether to invest or not, they're uncertain about what other people are going to do. That gives you a framework to get natural comparative statics about when you will get the biggest bang for your buck in terms of where you spend money. So, it's not going to give a one-size-fits-all answer, but it's going to tell you, based on probabilities and balance sheets of different countries, what kind of issues are going to make it better to do your intervention here or do your intervention there.
I look forward to reading that paper.
Okay. I look forward to writing it.
Okay, so since we're talking about the European crisis, does the global games literature have anything to tell us about also the causes of the European crisis?
I don't know that it does, but I think that it should. So I think that it is a sort of suitable framework to look at those issues. So, one debate about the causes of the European crisis that I think is very interesting is, especially when the sovereign debt issue first started hitting, it was interesting. Among my colleagues at Princeton, you had macroeconomists, people like Paul Krugman, who thought that it was a classic sovereign debt crisis, which is the problem that countries have incurred debt, and if people expect them to repay it, they'll keep lending. If they don't expect them to keep paying, they won't lend them, so there could be multiple equilibria there, so a classic sovereign debt crisis. Meanwhile, my finance colleagues had a different view, which is that the sovereign debt, that it happened to be sovereign debt that was causing trouble in these markets, was a little incidental. We'd just been having all these crises in the US to do with different assets, mortgage-backed securities, where there seemed to be some positive feedback that was driven by the nature of banks' balance sheets, fire sales that we mentioned earlier. So when people start selling assets, everybody else starts being under pressure to sell assets. So in that theory, the crisis happened to have to do with sovereign debt, but it might just as well have been mortgage-backed securities. Like at the beginning of the US crisis, it was just the nature of banking that created this coordination problem. So now that debate is, is it one or the other? No. Well, obviously there are going to be elements of both of them there. I think that it would be very natural to write down a theoretical model where you allow both channels to operate and see how they interact. A global games framework would be very natural for doing that. If you just write down naive economic models where people know everything that's going to happen and you get multiple equilibria, then you can't really look at one cause trading off against the other cause. Whereas if you wrote down a global games model that captures the strategic uncertainty, you don't know what other people are thinking, then you could really try and get at what's the interaction between these different channels. When is one channel more important? How are these channels interacting with each other? So that's something that should be done but hasn't been done.
And going back to the contagion issue,
Mm-hmm.
what's the relationship between these ideas that you're having now of this project and your earlier work on contagion, specifically your 2000 paper,
Mm-hmm.
Contagion?
Well, there's actually a sort of deeper theoretical connection, which is that I actually started out thinking about incomplete information environments like global games and seeing how what you did in one scenario was going to affect the incentives that you would have to do something in another scenario through higher order beliefs, through your uncertainty about what other people are thinking and so on. And at some point when I was doing that work, I saw people writing about networks in the early 90s. Network economics was relatively new. And I realized that actually the same arguments, there was a close theoretical connection between the arguments that were being used. Instead of having behavior spreading across different types in a game, you had behavior spreading across different players playing the game in the network, interacting with other people. So actually that paper was written very much as I got to those results by translating results. I mean, it says so in the paper, by translating results about incomplete information. And actually, I think that connection is underexploited. You know, there are these literatures existing in parallel. You know, people may be aware of vague analogies, but actually it can be made more precise. So I guess I think that it's a, you know, going forward, understanding how informational contagion and contagion across different players in a network, how closely related these things are, is going to be a very productive area of research.
Thank you very much.
Thank
you
you
very much for your time.
It's been a pleasure.